Greetings, folks. This is DC Investing, Reach Financial Independence, and I'm talking about topics that may help others to reach financial independence. And as of today, yesterday was the federal meeting, FOMC. They raised interest rates, and no, sorry, they didn't raise interest rates, they lowered interest rates. So, what that means for average investors is any funds that we have in our money market accounts will be earning slightly less. So I used the Fidelity system because the core account can sit in the money market. It was getting just a hair under 4%. So the Fed cut rates by 0.25%. So now it'll be 3.75% on the any funds you have there. And so overall, kind of the talk today is more on what happens to your cash that you have and what can you do looking forward with the plan from the Fed. So what the Fed is saying is that they're going to lower interest rates 2 more times this year, once in October, once in December. So what had been a rate plan or an interest rate earnings ability from a money market at 4% will end up at 3.25% by the end of this year. And so that's something to seriously consider because, you know, I think the quoted rate of inflation is somewhere near 3%, maybe 2.5 or 2.75 or something. You know, I think we all know that the real rate of inflation isn't what the government tells you. It's higher than 3%, particularly if you're buying food and energy and those sorts of things. So you have to kind of just play these games about what do you do with your cash. And you know, if you don't do anything to it, the inflation just eats you alive. So so our money market accounts by the end of the year are not going to be earning 4% anymore. They'll be earning 3.25%. So that brings the question of what do you invest in so that you stay ahead of inflation. And for folks who need to live off the cash that they generate from their account, you know, it had been somewhat decent to have a 4% rate of return. You know, if you had $1 million, that's $40,000 a year. That's going to change. So if you have $1 million by the end of the year, you're only going to get $32,000 a year, which is, you know, a significant change. So, so what can you do? And, you know, with anything, you know, we're just guessing. We don't know what's going to happen to the economy, but you can look at dividend paying stocks. And if you pick the right ones, you can actually keep the amount of cash flow that you had. So like, let's say you had been doing a money market account, you had $1 million, you were getting $40,000 a year, and you really need that in order to live. Well, you're going to get your funds cut by the end of this year. So what can you do? So one thought is look for the dividend paying stocks. And if you're not familiar with what that is, if you buy shares of a particular company, every share pays out a very specific amount of a payment to you once a quarter. And so the thing today that I was thinking of is take a look at Chevron. That stock ticker is CVX. Chevron is one of the largest oil producing companies in the world. Exxon is bigger, but Chevron is up there. So again, CVX, and it has a dividend rate of 4.5% as of today. So, you know, if your money market had been getting 4%, purchasing Chevron will give you actually a raise on those amounts. You get 4.5%. And something that's nice to know about Chevron is they're what's known as a dividend aristocrat, which means they've paid and raised their dividends for longer than 25 years. In Chevron's case, it's actually been 38 years of a stretch where it's paid the dividend and raised the dividend. And so once you buy shares of a stock, you can lock in that value on the day that you purchase those shares. And in Chevron's case, you know, if they continue in the future like they have in the past, you're not going to earn less than the amount that you get on this day, on the day you purchase shares. And they're going to try to raise the dividend every year. And so on your $1 million, if you bought that much in Chevron stock, you'd earn $45,000 a year, and every year going forward, you're going to get at least $45,000. Chevron is going to try to raise the dividend every year to keep their dividend aristocrat status. And so, next year maybe you get $45,300, or $45,000, $46,000 or something. And so that's kind of how these long-term dividend plays work, is these companies try to pay the dividend. Now, that dividend will come regardless of the shares going up or if they go down again. So, this is kind of more of an income play. If you need income from your portfolio, you're not going to get as much from your money market account. And we need to keep ahead of inflation, and a 4.5% dividend yield hopefully will be slightly neutral to inflation, or maybe close to it. And then with hope, the shares that you buy will also increase with inflation. Inflation just kind of eats everything. So slowly over time, hopefully the share value of Chevron stays above inflation. Your dividend, you're getting income to live on, it kind of stays ahead of inflation. So that's the hope. So there's one possibility. I like Chevron. It has, it's a higher dividend ratio payout than Exxon, because Exxon shares kind of appreciated more than Chevron did over the past while. If you need more income than that, then something that I'm interested in is a company called Hess Midstream. That is HESM. And the interesting thing about Hess Midstream is they actually pay out 7.2% of a dividend. And the Hess Midstream is a pipeline company, so they actually move oil and gas around. And if that 7.2% of a dividend sounds too high to believe, just kind of know that most of the midstream companies have dividend ranges in this range. So they're kind of between 5 to 9%. And the midstream companies are just meant to be dividend payers. That's what they're set up to do. They just kind of stay steady. They pay the dividend out to the shareholders. So Hess Midstream, if you purchase that with your money market account, you actually get a raise. So on $1 million, instead of earning, your 4% or $40,000 for a money market account, you're earning $72,000 a year from Hess Midstream. Now, the reason why I kind of lump those two together is Hess Midstream is actually owned partially by Chevron. So Chevron this past year bought Hess, which was another oil driller, and Hess had a 38% stake in Hess Midstream. So now Chevron owns 38% of Hess. So I would think that adds stability to Hess Midstream, because you have a giant oil major that owns 38% of it. And there's thoughts that Chevron in the future is actually going to purchase all of the shares of Hess Midstream. And a couple years ago, they did something similar, where they bought Noble, and then eventually bought the midstream company, Noble Midstream. So that's one of the thoughts of what that could happen. But in any case, purchasing either of those, Chevron or Hess, will give you a better cash flow than what your money market accounts will. Hopefully stay ahead of inflation and be a good long-term play. Now, if the economy tanks, people are going to spend less on oil and gas, and these companies could go down for a while. They're going to try everything they can to not lower their dividend yields. And so if you can just kind of ride out any downturns in the economy, then eventually these things will tend to go up, particularly because I really think we're going to have an inflation bout over the next while. The government is so far in debt, they're going to print money. It's going to cause the value of assets to go up. And I guess another thing is Chevron and Hess Midstream have debt, and when the Fed lowers interest rates, they can refinance that debt at a cheaper rate. So that's actually a tailwind for these stocks. So in general, we got to be really careful, because inflation can eat us alive over the long term. We have to put our funds into things that are going to stay ahead of inflation and provide the cash flow. So there's a couple of investment ideas. The Fed is lowering rates. your cash is going to earn less money. So time to try to put it into things that can continue to grow. So those are my thoughts today. What do you guys think? Do you think Chevron or Hess Midstream are good investment ideas? Any comments for the rest of the community here? And thanks for your time today. Bye.